Okay, welcome back. Next thing we were going to move on to was depreciation on machinery, then depreciation on buildings, and loss on sale of machine. Now, the depreciation on machinery, I'll go through it pretty quickly because we've done this type of calculation a lot of times. But just to look at where the figures are going to come from here, first of all, we have machinery, plant and machinery at the start, which cost 260 and has a net book value of 156. So cost 260 is an important thing at the moment. And then further down here, we will see the depreciation on plant and machinery is 20% of cost per annum from date of purchase to date of sale. And even seeing that makes you think that there's probably going to be some sale of machinery, and indeed there is. In part 2, it says included in the figure for sale of scrap materials, that's in the trial balance, is 1,800 received from the sale of an old machine on the 30th of the 6th, 2004. The machine had cost 22,000 at that date. Okay, so that's not important for now when we're working out the depreciation. But what is important is that you sold the machine on the 30th of the 6th. Also, I suppose it's important to note at this point that you didn't buy any new machine. So not like those questions where you traded in a vehicle, got rid of an old one and got a new one. In this case, you just got rid of an old machine, you sold it. So it means for the first 6 months of 2004, you had 260,000 cost value of plant and machinery. So if we wanted to get the first half of the year's depreciation, it would be 260,000 by 20%, 0.2 by 6/12 or a half. Okay. And then if you wanted the depreciation for the second half of the year, well, halfway through the year, you got rid of, where was it again? Oh yeah, a machine which had cost 22,000. So now, instead of the total cost of your machinery being 260, it's 260 minus 22, which is 238. So for the second half of the year, 238 by 20% by 6/12. And when we add the two of those together, we get the total figure there, which works out to be 49,800. So you've done that type of calculation many times before anyway. Okay, so the next thing is the depreciation on buildings, and in particular, I suppose you might wonder, like, why is this in the manufacturing account and not in the trading profit and loss? Well, they describe them as factory buildings, so we should have them in the manufacturing account because the factory is where the manufacturing takes place, and really, unless it tells you otherwise, you'll put it in the manufacturing account. So the buildings at cost were 450,000. However, we saw already in this question that they built an extension to the factory, and the work cost 40,000 and materials 18,000. So the extension in total cost 40 plus 18. It cost 58,000. So now your cost has gone up from 450 to, let's just put it in here, 450,000 plus 58,000 for the extension. So all of that, and we get 2% of it, isn't it? 0.02. Okay, and all of that comes to, hold on now, I have it written somewhere here, 10,160. That's the depreciation of buildings. I think that's straightforward enough. Lastly then, the loss on sale of machine, and I might have to do that working down here a little bit because there's quite a bit of work in that, even though it's exactly the same as loss on disposal or sale of the vehicle that we've seen in lots of questions so far, but we'll do it very quickly here. So again, it says included in the figure of for sale of scrap materials is 1,800 received from the sale of an old machine. So that's how much you got for getting rid of that old machine. The machine had cost 22,000 on this date. Okay, so what we want to work out is how much depreciation we've written off that old machine since the date that we bought it, the 1st of the 4th, 2000, until the date we got rid of it, which is the 30th of the 6th, 2004. So if I do my workings down here, it originally cost us 22,000, we said. The rate of depreciation per annum is 20% on machines. Let me double check that. Yes, it is, yeah. And then the number of years we owned it for, well, where are we again? It was 1st of the 4th, 2000 up until this time, 2004. So if we were going from the 30th of the 6th, 2000 to the 30th of the 6th, 2004, that'd be 4 years, plus another 1st of the 4th up to the 30th of the 6th is another 3 months. So it's 4 years and 3 months, isn't it? So multiplied by 4 3/12. 3 months. Okay, and that comes to 18,700. So that's the total depreciation on the machine that we got rid of. Okay, it had cost 22,000 in the first place. Okay, if we subtract the total depreciation from it, we end up with a figure of 3,300. Oops. So that is your net book value, isn't it? That's the value of the machine. Okay, now it already said that you received 1,800 from the sale of that old machine. So if you received 1,800 for something that you have valued at 3,300, it means you made a loss of, oops, we subtract that, it means your loss is 1,500. Okay, so just the exact same way as you've done others of these in the past. So 1,500. Okay, so now we're going to total that. All of that comes to 111,760. 760. And so we're going to add the 111,760 and the 170,220 and this. Now, if you, in some questions, a lot of questions, I suppose, really, you'll see these two added together already, maybe in here, and giving you prime cost. But in this example, we're just going to add the three of them right now, giving you a cost of 716,770, and that's your factory cost. Again, well, look, I'll put it in there, but it's not something that I've ever seen them giving marks for. Factory cost. So our next thing we want to do is we could have done this up at the top. I mean, we don't. It's not the way we do it, but it would have, I suppose, amounted to the same thing. But what we do is we add on our work in progress at the start of the year. So our stock of half-made goods, not quite finished goods, that we started manufacturing last year, but we hadn't quite finished. Because we certainly, those would have been the ones that we will first finish manufacturing this year before we move on to manufacturing any others. So we must add them onto the cost of our manufacturing. So where are we? Work in progress. So at the start of the year, let's see where they were. Work in progress, 24,150. 24,150. And just, I suppose, so we're clear, it's from the start of the year. It's the opening stock of work in progress goods. Okay. So adding that on there, 740, 920, isn't it? Okay, and then we subtract the work in progress at the end of the year. So as I say, it's just like what we did above, adding opening stock, subtracting closing stock. Except above it was raw materials, down here it's work in progress, and had we done it above it would have amounted to the same thing, but this is the way we do it, and you should do it in the exam. 04 we'll say. And how much is that figure? It is, let me see now, 28,550. There we have it. $550. And we're subtracting that, giving me 712 for 370, isn't it? Oops. 370. Okay. So that's our total cost of manufacturing this year. However, like I said, if we have anything like a gain that we got which might offset the costs, we should subtract it from the total cost, because it brings down our costs. So I said one of the things that could happen is, instead of having a loss on the sale of the machine, if you had a profit from the sale of the machine, then that should be down here somewhere. It should be subtracted from this, because it'll lessen our costs for the year. Okay, but the one thing that always gets subtracted, it comes up every year, is what you've seen in part 2 here, they mentioned it, sale of scrap materials. So sometimes in the manufacturing process, you use your raw materials, and while you're using your raw materials, for instance, if you're making something with sheets of metal, you might be cutting out shapes from sheets of metal to manufacture something, and you have little bits of metal left over, and these scrap materials then can be sold for whatever the scrap value is, and that offsets the cost of your manufacturing a little bit. So here we're going to have sale of scrap materials. So there is one little working to be done here. The sale of scrap materials goes in here, 5,500, I believe. Maybe we'll put the working in here just so we can see it. 5,500. But we already said that included in that figure was the 1,800 that was received from the sale of an old machine. So that is not the sale of scrap materials. And in any case, we've included that in our calculations here by calculating the loss on the sale of the old machine. So what we do is we must take off that, where is it again now? Take off that 1,800 euros from the 5,500, because it shouldn't have been included in that. So what's that? 4,537, isn't it? And we subtract that, so 708 anyway, isn't it? 708, and 7 from that is 670, isn't it? Okay, and that is your cost of manufacture. That's it, really. Now, one last thing. There's 2 more lines to go in here. Manufacture. There are 2 more lines to go in here, just in this 2005 question. In every other question we're going to practice from 2005 up to 2018, that's the end of it. It doesn't go any further than the cost of manufacture. But 2005 is a little bit different, but you should definitely take notice of it, because the extra little bit we're going to do in a moment is the type of thing that, if they feel like a question is too easy, they might add it in. In particular, in pre's, they love adding in more complex stuff that we haven't seen in a while. So I definitely take notice of it anyway, even though you won't see it in these questions again after this one. So what it is this is the cost of the manufacturing done in your factory to manufacture however many goods you manufacture during that year. But there's one extra little bit down here. It says in part 8 of the question, goods should be transferred from factory at current market value 800,000. Okay, so what that means is, what we do is we, if you like, we skip a line here and we put down 800,000. Oops. Okay, double line here actually, because that's the last line. Okay, and we call that goods transferred. At current market value, CMV will be fine. Okay, 800,000. Okay, so what we're saying is this is what it cost us to manufacture them. And what I suppose, to give you an idea of how you might look at this, is even though it's one company which manufactures these items and then sells these items later, it kind of treats its company like it breaks it into 2 areas, a manufacturing area and a trading area where it sells the actual items that it manufactures. So what it does is it says really that this manufacturing side of the company sort of like sells the goods they manufactured to the other part of the company, where they'll take these goods and then they'll trade them, they'll sell them on to somebody else for a profit. So what it's saying is that the goods were transferred to the other part of the company. It's still all the one same company at current market value of 800,000. But this is all it costs them to manufacture those goods. So what the manufacturer actually did in transferring them from one part of the factory, the company, to another, was made a slight profit on the transfer. Now, since it is the same company, that profit in a minute that we're going to calculate and put in here, that's actually just going to be then included in the trading profit and loss account again to create one big profit rather for the company anyway. So it's just an extra little step that really doesn't change your bottom line when we get to the end of the trading profit and loss account. Okay, so to get this profit figure here, we just have to subtract the 708,670 from the 800,000. If we do that, we get 91, isn't it, and 330. Okay, and we call that gross profit. On manufacturing. So factoring, I like to say, they like to say manufacturer in one of the exam papers. So, but if you just put profit on manufacturing as well, that will be fine. So that's the end of that. Just remember, though, I suppose, a few little things. First of all, for the examples we're going to do from now on, you won't see that again, okay? So it's a little bit different to the other questions that we're going to be doing. Remember that you could have subtracted down here with the sale of scrap materials, you could have a profit on the sale of a machine. What else has sometimes come up? I told you about the royalty payments that might come in as a direct cost. Oh yeah, under factory overheads, the only other ones that I've seen besides the ones listed here are you could have patents written off. So patents written off is kind of like depreciating patents. And if there was something like repairs to machines or cleaning of machines, but as I say, these are the norm, I suppose. But you could see any of those. But maybe make a note of repairs to machines and patents written off, because those really could come up.